Have you ever really thought about what goes on behind the scenes when you apply for a mortgage? I mean, it's not just about filling out paperwork. It's really more like a high-stakes detective story. Every single document is a clue and every number is a potential lead. Today, we're going to crack the code and look at how lenders are spotting and stopping mortgage fraud in its tracks. I mean, just imagine you're the one looking at the file. Is that bank statement showing a big, sudden deposit, a legit gift from mom and dad? Or is it maybe a sneaky loan designed to fool the system? And what about that W-2? Is it a perfect reflection of someone's income, or has a number just been tweaked? These are the kinds of questions that are being asked every single day on the front lines of financial security. And that's really the heart of it. The people originating these loans, the underwriters, the processors, they aren't just paper pushers. Not at all. They are the gatekeepers. You could even call them the paper detectives. And they're tasked with protecting literally trillions of dollars in the housing market. Their sharp eye is what separates a dream home purchase from a major financial crime. So here's our game plan. First, we're going to define what we're up against. What exactly is mortgage fraud? Then we're going to investigate the three main crime scenes: the loan application itself, the physical property, and then fraud that's committed by insiders. And finally, we'll open up the detective's toolkit to see exactly how they catch the bad guys. Okay, so what are we really talking about here? At its core, mortgage fraud is all about deception. It's any lie, any misrepresentation, any trick used to get a home loan under false pretenses. And this can be anything from a borrower telling a little white lie about their income, all the way up to huge, elaborate criminal rings that are orchestrating multiple fake loans all at once. And it's also important to know about the flip side of this coin, which is predatory lending. This is when the deception comes from the lender's side of the table. They're the ones pushing borrowers into these really terrible loans with awful terms. Both sides, borrower fraud and predatory lending, are all about exploiting the system for money. All right, let's head to our first crime scene, the borrower's application file. This is where the overwhelming majority of mortgage fraud gets its start. It's where a borrower tells their financial story on paper, and it's the underwriter's job to figure out if that story is fact or pure fiction. Now, what's so fascinating here is that for every one of these tricks, there's a countermove. Someone fakes a gift letter? Well, the underwriter then has to verify the donor's bank statements and trace the funds. Somebody alters a W-2? No problem, they just pull the official transcript straight from the IRS. Trying to hide some debts? A comprehensive credit report is going to reveal everything. It's this constant back and forth, checking every single claim against verifiable, official data. But the detective work doesn't stop with the borrower's story. Nope. The next step is to put the asset itself, the property, under the microscope, because sometimes the house is the entire scam. And this is a classic scheme. Let's say a criminal buys a rundown house for $100,000. They do a little bit of cosmetic work, then they team up with a crooked appraiser who says the house is now worth $200,000. Then they quickly sell it to either a naive buyer or what's called a straw buyer, someone they paid just to put their name on the loan. The criminals walk away with a huge profit, and the lender is left holding a loan on a property that's not worth nearly what they lent. So that just begs the question, right? How in the world do you stop something like this while it's happening? How do you prevent that bogus appraisal from ever getting through the system? Well, luckily, the system has a built-in tripwire. And this is it. The HPML rule is just a perfect example of a regulation built specifically to stop a certain kind of fraud. The second a property sale hits these specific triggers, a quick resale for a much higher price, an alarm bell goes off in the system. The law automatically requires a second, totally independent appraisal. And that second opinion is almost always what exposes the scam and stops the illegal flip dead in its tracks. Now we have to turn to the most difficult and, frankly, often the most damaging kind of schemes, the inside job. This is when the fraud isn't coming from a borrower, but from the very professionals who are supposed to be protecting the system. Okay, let's clear something up, because these two terms sound alike, but they're totally different crimes. Loan flipping is all about preying on existing homeowners. It's when a lender convinces them to refinance over and over again for no real benefit, just to generate fees. Illegal property flipping, which we just talked about, involves a fraudulent sale of a new property. It's a really important distinction for the people trying to spot these patterns of abuse. And there are other pretty nasty insider schemes out there. Contract kiting is basically making a second, totally fake sales contract with a higher price to trick the lender into giving a bigger loan. And equity skimming, that one is just cruel. It targets homeowners who are in trouble, promising to save them from foreclosure, but instead, they just steal all of the home's equity and leave the family in an even worse position. So, with all these different kinds of schemes, what's actually in the detective's toolkit? How do lenders and regulators connect all these dots and spot the fraud before it's too late? A huge piece of the puzzle is something called the FACT Act, which created what we call the red flag rules. This law basically says that every bank, every lender has to have a program to actively look for the warning signs, the red flags of identity theft, because that's so often the first step toward mortgage fraud. And here are some of those classic red flags. When an underwriter sees a credit report that's just littered with brand new accounts right before a mortgage application, it raises some serious questions. Is this person just in financial trouble, or could this be a synthetic identity, a completely fake profile built for fraud? They look for anything that just seems off. Every little red flag is another piece of the puzzle. And beyond what each individual lender does, there are industry-wide systems. The Mortgage Asset Research Institute, or MARI, is a huge shared database. It lets lenders report and track fraudsters. So if someone gets caught at one bank, they can't just go down the street to the next one and try again. It's basically a collective defense system for the entire industry. So at the end of the day, getting a mortgage approved is so much more than a rubber stamp. It's a really detailed investigation. It's this layered system of checks and balances, from the individual underwriter's sharp eye to the automated triggers like the HPML rule to the industry-wide collaboration. It's a constant cat and mouse game that requires everyone to stay vigilant. And that really just leaves us with one final and pretty big question. We're now living in a world of AI-generated documents and deep-faked video calls where the very idea of evidence is changing. The methods we talked about are powerful, for sure, but they were designed for a world of paper and pixels. So how will our paper detectives adapt their toolkit for this next frontier of fraud? That is the challenge that lies ahead.